Welcome back to the Dan Weston channel. All right. Well, we're getting into it now. Part 4. Okay. So we're going to talk about this is another option for your retirement account. You could do a 60-40 portfolio. Now, I don't have bonds, so some of this is not, my forte. So we'll just go over this briefly. I can to make a long story short, I don't do 60-40. So, but it is a valid option for your retirement account. Okay. So it's funny because I used to ask Cole, I'm like, where did the 60-40 come from? Because this wasn't exactly something I'm very familiar with myself. And so apparently it's from modern portfolio theory, which came from a Nobel Prize winning economist, Harry Markowitz, in the 50s. So we're talking 80 years old almost theory about portfolio construction. So I don't think from what I understand, he didn't lay out 60-40, but it came out of his work. It developed into this. The original 60-40 was 60% US, 40%, or 60% US stock market, 40% total bond market in the US. So we're going to stick with that portfolio allocation. I understand you could technically, some people would view 60-40 include international in it, but then I would argue you're doing a 3-fund Boglehead that we covered in a previous video. So we're going to do the traditional 60-40 split that we're talking about here. So basically, why would you do this? You would do this because it gives you exposure again to multiple assets, not just equities, but also the debt market. And it will also, as we'll show you, help you with lower volatility and drawdowns in your portfolio. Okay. So, as this is discussed in this article, as we trended for some time, the US markets, you can see, have trended down interest rates for since like say the 80s. So for some 40 years, interest rates were trending down in the US, which would have benefited actually having bonds in your portfolio because as the interest rates fall, the value of the bonds would go up, right? Ideally. But a lot of people could say, well, is this dead? Because now we got to the you could say the end point of this trending down came about in after the Great Recession all the way up to the fall of 2021 when basically zero interest rates went away and we started increasing rates. So some people say that time period is gone now. So this portfolio is dead because now we're probably going to be an interest rate rising environment for some time. So this is not a great allocation method. A lot of debate online about this actually has the most contrarian takes of all the ones I've covered so far. Is this one, the 60-40. So it also, like, inflation matters to bondholders. I don't want to get into, I'm not a bond guy. So I'm not going to pretend to get into that part of it. So I've showed this before because I think it's a great graph. So if we look at the 60-40, that would be this one right here. You can see it's kind of like the sweet spot in the middle where you get a pretty good drop in volatility from 100% stocks. So the lows are not as low, and again, the highs are not as high, but you're still getting the vast majority of the return your portfolio is getting. You know, you're getting almost 9%, whereas 100% stocks here, you're getting like about 10. So you're not missing out on that much average return, and you've minimized the volatility pretty well. That's the idea of why you would do this. Okay. So we can look, if we back test this. So let me go here. So what I did was I took the mutual fund for total US market, and then I took the Vanguard mutual fund for total bond market. I did 100% portfolio one's 100% US stocks. Number 3 is 100% bonds. And then number 2 is 60-40 that we're talking about. So if we run this, I'm running it from 2000 to present. No rebalancing. So you can see without any surprise, the 100% stock portfolio did better by a pretty good clip. So 9% average compared to the 60-40 7.5. But again, like we said, you've cut out quite a bit of volatility and you still have gotten a pretty good return. Like, not bad. So probably better than some of you would have thought, I bet. But your standard deviation is less. So you were less volatile. your volatility's down, so forth. I mean, no one's buying 100% bonds. Just to show you, 100% bonds, you'd get creamed. Okay, not surprising anyone. So if we look at like, let me go down to annual return. No, that's not the one I want. Let me go up. Okay, here it is. Sorry. So drawdowns, you could see the volatility, right? Portfolio 3 is orange. So you could see like the bonds are doing their thing. They are providing stability, ideally. That's why you would have bonds. So historically, they should perform. Who knows the future? But historically, they should perform okay. Um, they won't go down as much, and hopefully they will give you some sort of stability in your portfolio. Although we could also look at some articles where stocks go up and bonds go up at the same time and so forth, so they're not exactly opposites, but you could see the drawdown difference between the different portfolios. And then the 60/40, you could see like it kind of pulls some of the volatility, like during the Great Recession, right? The volatility not nearly as bad. And then we can go to more modern day during COVID. Again, you can see not nearly as much of a drop. So it took some of that volatility out of your portfolio. So maybe that keeps you from panicking, right? Maybe that not losing 40, 50% of your portfolio. You imagine a Great Recession, right? If you were 100% stocks, you lost 50% of your value of your 401k. Someone 60/40 only lost 30%. So, and then the person, well, I don't know why you'd be 100% bonds. You wouldn't have lost anything really, but maybe this kept you from selling your whole 401k and cashing it out because you were freaking out because you lost your job. Looks like the country's going to hell. You open your statement, you've lost half your retirement account. And there were people that did sell out. And I have the videos from that back then when they interviewed people. So, but maybe the 30%, maybe you didn't do that. That's kind of what I would view as the real reason you do a 60/40 in the end. It'll keep you in the game, even though you're not optimizing performance, maybe, but it keeps you in the game, maybe, when things get bad in life, because you're a person. So there's that. Annual returns. No, we're not going to get into that. Okay. So there's the performance. Now you can see like bonds, like 2022 was a weird year because bonds should do pretty well, right? When the market gets creamed like it did. But they didn't do that much better, which is not really that surprising to me. Like last year, you had these huge increases in the interest rates. And as that happens, the bonds' present values are getting crushed, and it's just a big mess. So they didn't provide that much help to you last year in 2022, which is I think why you see a lot of articles from that time and now saying that this portfolio allocation is dead based on like what happened in 2022, because they didn't really save you much of they didn't really help you much last year. So that's a bit unusual historically for the way bonds perform compared to the stock equities. A very unusual year. Clip that. So here's like an article from Goldman Sachs. I found a bunch like this where they were talking about, is this dead, this portfolio allocation? So obviously the big downfall, if I look at the historical 60/40, not a more modern day approach, you have no international stock exposure. So that's a negative. So that's not great. And I think you have a lot of unnecessary bond exposure. If you're like 20 years old, 40% bonds is, so this is like very, you can't optimize this portfolio. It's almost the same flaw as like a target date. Target date funds are just built for everyone, right? Doesn't matter who you are or what your situation. This portfolio, same thing. There's no flexibility. It's 60/40. All right. And it doesn't matter if you have a pension, if you have real estate, if you have a huge cash trust ready for you, or if you're a doctor or a janitor. This portfolio has no sort of adjustments for you. Did it 60/40. So that's a big flaw I see also. What else do I want to say about it? So historically, I mean, bonds have done okay, right? They're not going to blow your socks off. Bonds have a long track record. they perform well. In the vast majority of years, the last 100 years, bonds have had positive returns, not negative. So that's the stability you're looking for. So there's that point. And then here's our 60-40 is alive and well. So you could argue maybe you want to be in bonds now because if we have maybe the interest rates are going to start to drop again, increase the value of bonds, present day bonds. That's up to you. Here is a percentage of years stocks together and bonds and rise together. All right, you could see there's some differences there. I mean, it's hard for me to talk. I don't really consider bonds. I never really have. I don't want to necessarily tell you too much. So this kind of gives you a sense of, I saw this from another video. I looked at intermediate treasuries compared to the US stock market. So you see like even high inflationary times, like in the 70s, stock market tanked. The bond returns actually did fairly well. So this can help you in those time periods, technically, where high inflation, right? But then we come to today, right? So the 70s, high inflation, kind of a mess of a period, not too different from 2022, but yet not the same. This is the weird part. So why did it work in the 70s, but it didn't work last year? The bonds did not perform last year. You could go more into detail about why, but I found that kind of unusual. And that's why I think why some people were like, is this really, the bonds aren't doing what they're supposed to do in 2022, then what good is this portfolio? And it's not my favorite. I'm not going to mess around. I think you can do it though. I'm not going to tell you can't. If you are scared to death of losing money ever, and if you just imagine opening your brokerage statement and it's like negative and you freak out every time and you're that screwed, you feel like you're screwed and you want to cash out your 401k unless you always see green, this might help you to stay in the game. This type of portfolio allocation. This might be, now I'm just talking about working professionals. I mean, we're not talking about retirees. All right. That's retirees. I mean, this is a logical conclusion. You could almost say to at the end when you do retire, but that's for a different day. So here's some Reddit people. Is a 60-40 dead? So 4 months ago. So we got, some people are going to say a bunch of stuff. I swapped a good chunk of my stocks into bonds 4 months ago. Okay, like here's again, you pick a strategy and you stick with it your whole life. I've said that. Like, so one of these 5 that I'm showing, I'm like, you pick one and that is what you're going with. Stick with it. Because look at this guy. He swapped his stocks for bonds 4 months ago. So one of the best runs in the stock market since late October, the run we've had recently where like every stock is like vertical lining. He bailed on the stock market for bonds. So that's a great comment for you to understand. You pick one of these strategies and you don't deviate from it. It's your strategy. Stick with it. All right. Where you're going to fail is when you keep flipping between different strategies. So, these people, retail, man, killing me. Trying to see if there's any interesting comments. Why are you acting like timing the market is a bad word? It's perfectly normal to change allocations. So tweaking your allocations is fine, but changing your investment portfolio strategy, I mean, that sounds terrible. I tweaked mine, and I'll get into it probably in a follow-up video to the series. I did a slight tweak to mine. I just did it last week. I do an annual review and I do slight allocation tweaking. But I'm not wholesale swapping funds and selling stuff out like this and taking growth funds and putting them into bonds or something like that. This guy, just be 100% equity so you don't have to worry about rebalancing. Okay. Well, the next one we cover will be 100% equities. We're going to get back to 100% equities for the last one, just like the first. This comment. If your portfolio is targeted 60-40 and now it's 70-30, I mean, I've seen some people say, well, you can do this, but make it 80-20 instead of 60-40. I'm like, okay, but that's not really, this is 60-40 strategy. That's what this is. Whereas the 3 Boglehead, there is no specific breakdown. You can have your own different allocation of the 3 funds. But obviously a 60-40 can't be 80%, 20%. So here we go. At the start of the year, I was close to 100% equities. Now I'm getting closer to 70-30. I mean, I think you should have just started the year at 70-30 if that's what you wanted to do and stick with it your whole life. maybe slightly tweak it 1 or 2 percentage points as you get older. But these people they're making rash decisions. So there we go. So that is 60/40. I If you're like 20 or early 30-year-old working professional, I don't really like this. I think it's too much bonds. I I guess if you have like a career where there's a high likelihood that you could be unemployed, and I hate to say it, but if you feel like there is a chance you could be unemployed and you might want to have access to your funds and maybe your 401k, this might be a good option, because then ideally there'd be a less volatile, like say in 2000 in the Great Recession, if you had bonds, it would have lessened the drop in your portfolio. If you needed to take that money out to survive, you would have only had a 30% hit, not a 50% hit to your portfolio. Um, and that shows in retirement, same idea. Imagine if you're doing 4% withdrawals your portfolio, right? The bonds will help you level out those volatile periods. But we're not talking about retirement, though. I don't want to get into that. This is not my favorite. I would say of the five that we're covering, I would say 60/40 is probably my least favorite of these five. But if you do it and you've done it for a long time, I'd be interested to hear why. If you're retired, okay, I get why you do it if you're retired. I'm talking about like a working person. Like, why are you doing it? I'm just curious. So with that said, we will cover the last one now coming up, which will be a familiar topic to people that know a certain person I'm friends with. So we will cover a total world stock market portfolio. All right. We will see you then. Bye.